What is up, you guys? Pete DiCarlo here, and this has been a video I have been trying to refrain from doing since I started YouTube, and it's probably the number one question that I get, and that is, what is options, how do I trade them, and how do they work? And after a couple months of this being the number one question, I decided that I finally have to make a video on it. So sit back, relax, and let's get started. I want to remind you that there will be a link down in the description to join our private stock market academy 100% for free for your first month. I understand a lot of people are getting laid off because of the coronavirus. A lot of people's retirements and portfolios are really just being hammered now. So financial literacy and understanding the markets is really of a high importance. So I want to give you the first month, you get 100% access to everything that we have 100% free. The link is down below. For the time being, don't really worry about what is over here. We're going to talk about the very basics of options, what an option is, what a contract is, what a premium. But in order to get to that, I want to start with the simplest form of an option. So over here is Jeff, okay? Jeff owns this house. And right now it is January 2020 in this world. This is Matt. Matt wants to buy this house from Jeff, but he doesn't have any money yet. So he goes up to Jeff and he asks, if you hold this house for 1 year so I can get the money together, I'll buy it from you for $125,000. Jeff says, okay. So Matt is going to sign a 1-year option contract for this house. This means that Matt will have the option to buy this house in 1 year for the agreed upon price of $125,000. 1 year goes by. The housing market has been great, and now the house is actually worth $150,000. Matt still wants to buy this house, so he exercises his contract and purchases the house for $125,000 from Jeff. The house is now worth $150,000. Matt paid $125,000, which means Matt made $25,000 in profits. But let's say that this doesn't go as well as he plans. And actually, instead, 1 year goes by and the housing market crashes. If Matt were to buy this house and exercise his contract, he would actually lose $50,000. Remember, Matt does not have to exercise a contract if he doesn't want to. And in this case, why would you want to exercise your contract? If you're going to buy this house for $125,000, but it's only worth $75,000, you're going to end up losing $50,000. So there's no reason to exercise this contract. It just doesn't make sense. In this scenario, Jeff really ends up losing because he has held this property for an entire year. And he took the risk of Matt not buying it. Obviously, Matt's not going to want to buy this. He's not going to want to exercise his option because he's going to lose money. And this is why in options, we have what's called a premium. And Jeff had Matt pay a premium up front when he bought the contract. So if Matt decides that he doesn't want to buy this house, Jeff will keep the premium. And so now let's get over this because this is where you're going to start seeing the correlation with a stock option. So obviously, it's January 2020. The house is worth $100,000. Jeff owns the house. Matt wants to buy it for $125,000, and we've gone over that. So when the deal first starts and Matt decides he wants to buy this house, Jeff does realize that, hey, if the price goes down, Matt doesn't have to buy this house. So what ends up happening is a premium is put on every single options contract. Now, in this case, for real estate, the premium that the two men agree upon is $5,000. So when Matt signs the contract for 1 year in advance, Jeff gets a $5,000 premium. This means that if Matt decides he's not going to buy the house, Jeff gets to keep the house and he gets Matt's premium. Let's look at how this will work with options. And on the right over here, this is a leap option, and I'll talk about that in a course in the future. This is a leap option that I own right now on Wynn Resorts. And this is the exact setup, the same way, just with a visual aspect so you can get a better understanding of it. I currently have 2 options contracts. Now, March 2020 of this year is when I bought it. The price of Wynn when I purchased this option contract was $43.02. The strike price on this option is $90, and it expires in January 2021. I have 2 options contracts, and something to remember is that one options contract is worth 100 shares. So the premium on this was $6.05. And now you have to times that by 100 shares. So the premium really was $605. And I bought 2 of these. So now, say, by next January, if Wynn Resorts is not at the strike or my break even, I lose that premium entirely. So now I want to go over where you get your break even price. And this messes a lot of people up because they see the $90 strike price and they think that if Wynn Resorts were to hit $90, I would break even. But that's not the case. In order to find your break even, you have to take your strike price, which in this case is $90, and add the original premium that you paid for the option. So in this case, the strike was $90 and the premium that I bought it at was $6.05. So if we add these two together, you get the strike price at $90, the $6.50 premium. That is a break even of $96.05. So Wynn Resorts has to hit $96.05 by January 15th, 2021, or I lose everything. So if we take this example, if Wynn Resorts were to go up to $150 a share, by the expiration, Matt, or me in this case, could exercise his contracts and buy 200 shares of Wynn Resorts for the strike price, which is $90 per share. In this case, I or Matt would make $60 per share. Now remember, I have 2 contracts. One contract represents 100 shares, so I could buy 200 shares. Now I would make a $60 profit per share, multiply that by 200 shares, and I or Matt would make a profit of $12,000. If Wynn were to close even 1 penny below my break-even price, Matt or me would lose the entire premium that we put up, and Jeff would keep it. So in this instance, I'm actually up on this. So as the price of the stock goes up while I'm owning this contract, the premium will also go up. If Wynn Resorts closes even 1 penny below $96.05, Matt or myself would lose our entire premium and Jeff would keep the premium. This is the power of options. And in my next course coming next month, we're going to talk about the risk that Jeff is going to take on by writing these contracts. And that's where we're going to talk about writing naked calls and puts and all of that. But for now, I just want to do a quick walkthrough of what options look like on Robinhood and how you can decide what is a good or a bad option. Now, the first thing that you're going to see is contracts. That's how many contracts you have purchased. And remember, one contract is worth 100 shares. You're going to see what the break-even price is. The break-even, like I said, and we're talking about calls right now, the break-even is going to be your strike price plus the premium you originally paid. So like we said, the strike price was $90. Our average premium was $6.05. So $96.05 is going to be your break-even. Now, as the stock goes up, your premium goes up. So you can see the premium, if I were to buy this exact option today, I would have to spend $7.65 as a premium, and therefore it would move my break even on Wynn up to $97.65. A couple more things that are going to be extremely important when you're looking to purchase options is the volume and the open interest. Now, in this case, the volume and the open interest are going to be low because I'm buying a leap option, which is essentially just a 1-year hold. But if you're trading, you don't want to go out that far. You want to always add 2 weeks longer than you think you need when you're purchasing an option contract. And you want to see a high amount of volume and a high amount of open interest, because The volume is how many contracts are being bought and sold of that particular option within that day. And if you want to be able to get rid of something, keep your trade liquid, you want to make sure there's high volume so you can take profits or cut losses accordingly and get in and out pretty fast. One other thing that you're going to see is theta, and I'm going to talk more about this in the course. Theta is your decay. Options contracts decay over time. The further out in time you go, and the closer to in the money, or the closer to the price of the stock at what it is now, the less decay and the less theta you're going to have. If you buy something that expires in 3 days and the stock has to go up 40% in order to hit your break even, your theta is going to be massive. So in this instance, for every day that I hold this, I lose $2.67 per contract. But these numbers can get extremely high if you're trading something volatile. I remember when Tesla was up to $1,000 a share almost, I bought a weekly put just to day trade, and the theta was $347 per contract that I own. So theta can eat away at an option very quickly. And that is going to be it for today, guys. I wanted to give you guys the basic understanding of how an option actually works. If you want to get enrolled in the Capitalist Academy, which is our private stock market membership group, I will put the link below. Remember, it is 100% free for your first month, and I will be releasing this course in the coming weeks. Make sure you hit the like button, comment, subscribe, share this video with anybody else who wants to get a better understanding of options and how they work. And until next time, guys, stay safe, and I'll see you.